I'm very pleased to welcome back to the show now Bob Hoye. Bob, of course, writes Pivotal Events. He joins me now on the line. Bob, thank you so much for finding time this weekend.
Yeah, good morning, Mike, and good morning to the listeners.
Well, there's certainly no shortage of things to talk about, and I just wanted to bang through a couple of things. I mean, the big one, obviously, is the change in environment under Donald Trump. There's a lot of ways we could measure that, but I'm more interested in economics and investment.
Oh, yeah, this is remarkable, and the irony, Mike, is that the Obama administration was perhaps the most anti-business administration in U.S. history. And it's possible to suggest that the Trump administration is likely the most pro-business administration in U.S. history. It's very dynamic times, and it certainly has caught a lot of observers offside. But what it has prompted in the marketplace is what I've been calling as the rational exuberance. I mean, you'll recall that back in December of 1996 is when Chairman of the Fed, Greenspan, described the market as irrational exuberance, and then it kept going up until 2000. But at any rate, because of the change in administration to pro-business, we've been calling it a rational exuberance, and it's taken flight. And you're beyond valuations for the stock market, but then valuations compared to earnings and whatnot really don't matter when you're in a flying market, because there'd always be an analyst to explain that the earnings are better than they really are, therefore the market isn't as expensive. But at any rate, the liftoff has been wonderful, exciting, and it is now beyond rational. But we're not saying it's irrational, but I think people can ride it for a while. Oh, back in October, November, whatever problems there are in a market can clear, that's a seasonal low. And then came the election, and then came the explosion. But then we used a couple of other items, like basically the commodities, the industrial commodities, and crude oil, and base metals. We figured they were likely to rally out to around March at least, and they have, and that's been a support for the financial or for the stock market. And the other one is with a reasonably favorable crude oil price, your credit spreads on lower grade debt relative to high grade would continue to narrow. That's now becoming really quite a fabulous narrowing. So that can continue. And then we've got one other item in looking at the latest report on New York Stock Exchange margin, which is up there at a record. And that, of course, it needs to anticipate an important high to have that margin debt step down a notch. And, it's always a month behind. And so that one looks like the market can carry for a while yet, but at least it gives us an outlook whereby one can recognize the top when it comes along, that you would have a setback in margin debt, and then following that, a MACD sell on using the S&P. So the stock market is wonderfully exuberant, and it could run for a while yet.
Let me come back to something you're saying here, Bob. We can go first to the general commodity markets, but you mentioned specifically the industrial commodities like crude oil. They're short-term and long-term, but again, in Canada, man, have we ever seen a recovery there boost our stock market?
Oh, yeah. Yeah, you had the crash in crude oil right down to 26 in a year ago, January, February. And it was so devastated, you knew that it was going to have a lengthy recovery. And there's still nothing really wrong with the U.S. economy. It's not growing strongly, but there's nothing wrong with it at the moment. But at any rate, crude has had the bounce up to into the young 50s. And ideally on this one, you would hope for a sharp pop-up to overbought to end this move. And I don't know whether it can just quietly roll over. It's had a bit of a correction the last week, but there's still a chance for a pop-up in crude, which would be also very positive for spread markets and for the stock markets. And base metals, I don't know, oftentimes you can have a high for copper in around March. So, but, Mike, the other one that is always worth monitoring is the action in the U.S. dollar index, and that generally the traders call it the DX. And on our work that had the high a couple of months ago at 103.85 with very good momentum, so we were calling for a correction for a while. And the other one that we look at for bottoms on the dollar index is the index itself working on a bottom, but also accompanied by the 20-week exponential moving average, and that's kind of helpful on some series, and it helps with the U.S. dollar index. And both needed to put in a base, which they have done. Then you would want the dollar index itself moving up and staying above the extended exponential moving average, which it has been doing, and then it sort of touched a while here at 102, and getting above 102 would be pretty encouraging on the dollar rally, and getting, of course, above the 103 level, and then you're away. So at the moment, this bottoming process on the dollar is looking like the one in sort of May, June of 2014, which was followed by an absolutely outstanding rally. So on breaking through the 103 level, you can see the chart working up to maybe 110 or 112, which would be a significant rally.
Well, the other side of that, of course, which we saw hints of this week, was the Canadian dollar, what was down 2 cents for the week. And obviously, if you're getting a strong U.S. dollar, the corollary is the Canadian dollar will be slipping. So that would suggest, a significant weakness in the Canadian dollar if the U.S. gains that kind of momentum.
Yeah, okay, that indeed, off of the U.S. strength, but actually, considering the federal government in Canada, the Canadian dollar can go down anyways. So it's not particularly good. The government federally is a liberal government. They like big government, and they've got a lot of big government there to support them. And their ambition knows no limit, so often, under such circumstances, the currency will be abused. So we're not positive on the Canadian dollar.
Well, I'll tell you, if Michael Levy was alluding to this earlier in the show, talking about some of the rumors about a rise in the capital gains tax in Canada, my goodness, if that happens, juxtaposed against a dramatic drop in taxes in the U.S., I don't have to get a PhD in economics or finance to understand that that'll put tremendous downward pressure on the Canadian dollar, on our economy, et cetera. So, yeah, really interesting times, as you started with, Bob. Like, it's a sea change in the States, and not just out of style, that's obvious. But if we can get past the style issues with Mr. Trump, he's talking about a fundamental change of the business environment, and that has, that ripples through the stock market, but the currency markets, the credit markets, you name it.
Yeah, well, historically, I've been calling it a popular uprising, and actually, it's global because the Brexit vote in England in June was a step to get removed from remote and authoritarian government that was unaccountable. And for most of the people in the United States in the flyover area in the middle, Washington, D.C. is remote, unaccountable, and out of control. And so it's the popular uprising that is driving things. Trump just happens to be the leader.
Couldn't agree more, yeah.
And then also, with Trump actually winning, and what is happening now, Mike, is that the popular uprising has an executive.
That's a great way of putting it.
It does.
Yeah.
And, of course, the left is going absolutely berserk. They can't believe this. They're inventing stories about the only way they could have lost the election is because Russia intervened. I mean, really, how absurd can you get? But their ambition is, again, they were there for unlimited government, and their ambition to oppose the reform that's going on now is also without limit. They'll push every button, do every sneaky trick and everything else. But I saw a Rasmussen poll, I think, Thursday. Trump's personal popularity is up to 53%, which is not bad. Now, there's a whole lot of opposition to him, but nonetheless, as we've seen in Canada with Prime Minister Harper, the left and its media were very nasty with him for a long time, and Harper was polite. Mm-hmm. The same thing happened with Reagan back in when he was president. They threw all the mud they could at him, and it didn't stick, so that was then the term the Teflon president. And they worked him over as the cowboy with the nuclear bomb, and it didn't stick, and because, you know, he had the support of the people, but the main thing there was that Reagan was polite. Now, Trump is not polite, but the against him would be just as intense if he was polite. Mm-hmm. But then maybe, Mike, at the end of it all, you need somebody that's a street fighter, as are the Democrats who are opposed to him. They are nasty street fighters. So it's a fascinating struggle.
I'm talking with Bob Hoye, institutional advisors, editor, author of Pivotal Events. I got to take a break. When I come back, I got to talk to Bob, though, about the change in interest rates. I'm looking at this huge, momentum, at least in towards the probability of the Fed raising rates in March, but also another couple of times. What does it mean for the bond market? What does he think for interest rates? Because that's the big one. I'll talk with Bob Hoye about that when we come back right here on the Money Talk. Oh, I could listen to James Brown all day long. Hey, by the way, my shocking stat is coming up. It's if you've just joined us, it's the most disgusting, the grossest, gruesome, shocking stat I've ever done, and it's about us, Canadians. Wait till you hear it, but don't have your breakfast before it. Bob Hoye is with me right now, Pivotal Events. He's also he's institutional advisors. He writes Pivotal Events. Hey, Bob, let me just get to sort of one of those Barbara Walter questions, and that is the long-term bull market in bonds over?
Yeah, but in a couple of stages, Mike, because last July on the long-dated treasuries in the U.S., which is the main market, became exceptionally overbought on technically. And then, of course, in Europe, you had interest rates down to negative in some jurisdictions. But at any rate, we used the U.S. market because it's less rigged than European markets, and figured that if it was going to be a technical change in the markets, it would show up in the U.S. and it would be best to analyze there. And indeed, the market did blow out, and it did suffer quite a sell-off right on down into December. And then you've had a rebound here now. So there's that side, the Treasury market, which also trades with the Government of Canada's. But then you have the other aspect, which is the low-grade stuff. So then back in last summer when we made the call on long Treasuries, we said that probably the action in low-grade stuff like junk bonds would continue. And it has. And indeed, the decline in yields, the CCC rated has come from 20% down to 8 3/4. Don't quote me on the numbers, but generally. And the spread between the junk bonds and treasuries has narrowed commensurately. So it's been a fabulous market there, and but it's now approaching some overboughts. We're not quite there for the big call, but when the low-grade stuff concludes and rolls over, this is going to be very nasty. Now, the thing to get across is that the rise in interest rates is not due to the Federal Reserve. The Federal Reserve is following the rise in interest rates, which started in June. So at any rate here, the other one is it won't be due to a resurgence of inflation in tangible assets and commodities and wages and that sort of stuff, CPI. It will be due, we guess, to the inability to service debt. Now, the amount of debt that's been issued, it's staggering. It is amazing. It's been the biggest financial bubble in history. And on any debt bubble, it's taken on, enthusiastically. And nobody ever thinks, how am I going to service this debt? So what you have here now is, as in the past, so much debt is taken on that with a normal business economy, it's impossible to service. So then the whole thing starts to contract, and the economy heads south, earnings head south, and it's very difficult to service the debt. And also with, jurisdictions such as provinces or states or federal governments, their debt gets difficult to service too because tax revenues slow down. So there's already a bear market for long treasuries, and let's put it this way, maybe in the second half of the year after June, you could see a bear market developing for low-grade stuff, and in which case the biggest bond bubble in history would be over, and it's not due to inflation, it'll be due to the inability to service debt. So,
well, Bob, we got to leave it at that cheerful note. But yeah, I think that's such an important message to get through there for people. Bob Hoye, thank you for taking the time. Institutional Advisors, Rights Pivotal Events.